Well, it's been nearly a generation, 25 years since the stock market crash of 1987, when the Dow experienced its worst one-day percentage loss, 22.8% in 1987. Bill Cerubi, he was then at Payne Weber, which is now part of what, UBS?
Sure is.
Bill's the editor of Cycles Research and a frequent guest who stops by here and talks to me. Bill, what was going on that day? The market was already down about 10% or so, the Dow, in the month of October. And then Monday comes around. People thought, well, this might be the day we turn around, right?
It was largely unexpected, and I'll always remember that day because I was at a trading course. And the fellow teaching the course flipped on the screen, and all the numbers were red with big minus signs. And he had participants there who didn't know anything about the stock market. Like, why are all the numbers red? They usually decline that much. And
just an everyday, any old day at the market. Yes. Not quite. So down 508 points. You had Myron Candell telling you about it on CNN Financial News. His buddy Lou Dobbs, then a strapping young 42-year-old buck. Lou, all right, market crumble. Bud Fox was a broker back in the fictional Wall Street movie. But you were actually working with a guy like Bud Fox and other people on Wall Street at that time. So panic sets in, the market tumbles.
Yeah.
Who was gutsy enough to go in and buy? Were there people who were buying the market then?
Oh yeah. Yeah, with it down that much, I remember Dick Diamond, the trader, saying, I guess you buy December calls right here, and that was the right move.
Well, that would have been 2 months away, and that did pretty well. Yeah. This is the year 1987, a very wild year. You've got stocks measured by the Dow in green. This is gold, and here's government bonds. So you had a 44% year-to-date gain in the Dow through August. What tripped things up from there? It was what, worries about currencies and relative valuations thereof?
I just think the market got too far ahead of itself, and there was just a liquidity problem, and an air pocket opened up. And that's it. These things happen. I don't try and attach any specific fundamental causation.
It was a big tumble for sure. But if you look here, the market began with the Dow around, the year began with the Dow around 1900. Topped out above 2,800, fell back down to 1,900. So you just lost your gains for the year, and it really wasn't. And then, since 1987, here's 20 years to the 2007 market top, which we're pretty close to right now in the S&P. Look at that, 20 years of gains. You would have done just fine buying then. But we had the policy makers come out. Alan Greenspan was a new chairman of the Fed. He had just taken over for Volcker. James A. Baker made reassuring statements. They would provide liquidity. We've already got a lot of liquidity in the system right now, but do you, Bill, as a guy who was back there in 87 trading, see similarities today to 1987, where we could have an air pocket like you described?
That's what I think we're starting today. There are several monthly counts. We are exactly 5 years from October 2007, 5 being a Fibonacci number, so that also makes this month notable. But in the words of my old pal Bob Miner, we have now a one-time cycle ratio. If you take the 2002 to 2007 period and you map that out, you add 5, you come to this month. Or my old friend, the late George Lindsay, my neighbor down in Greenwich Village, would call that a mirror image foldback pattern. 2002 to 2007, run it forward 5 years and you come out to this month. These are not the only counts, there's about 5 of them. So until we get to October 31st, I'm not so confident about the market. But right now, the way this tumble looks, my intermediate term cycle does not bottom till the 3rd week in November. So we may be in for a tough time here. Positive sentiment has built up. We had negative sentiment, which kept the market, in terms of contrary opinion, kept the market up and held it up all through August, all through September. Now the sentiment is starting to turn positive.
One thing is that now you got the Fed with loose monetary policy. There you wanted the U.S. wanted to prop up the dollar, so they wanted a more aggressive, a stronger dollar policy, if you will. So that's positive. But maybe 2 years down the road, in 2014, 2015, when the Fed stops these low interest rates, we could have the bond market tank and a similar crash develop. If you hold Google, you don't worry about a whole market crash. Your stock just crashed from 760 before earnings came out prematurely on Thursday to below 670 bucks. That's a pretty big tumble of more than 10% for Google. Apple's down about 10% from its highs. Names like McDonald's too reporting crappy earnings and going lower. So you're positive on the overall market. Any sectors in particular that you like?
I still like healthcare. And I still like financial stocks. I think they'll both go higher. And selected technology stocks. There you have to be careful and do your fundamental analysis and sort through the companies pretty carefully.
Right. Bernanke's committed to doing the $40 billion per month of mortgage-backed security purchases. You see this as inflationary at some point down the road when the money supply, when money's actually moving again?
That's the definition of inflation, sure.
So
No, I think, well, my long-term composite commodity cycle turns down in Q1, and Q1 February's following an election are down 70% of the time.
Yeah.
And I have a panic cycle, which I gave you earlier, which rises to a peak in that first quarter. So I think Romney's going to get elected. I think initially there'll be a euphoria, and then I think stocks will tank in Q1. Commodities will get hit, but they'll get hit far worse, because I think the election will convince people that at least they might cut back on the rate of increase, which is what Reagan did.
Just a turnaround.
And that will be
good.
disinflationary. So I think commodities will take a hard hit. I think Q1 will be very rough. But I'm expecting the market to stabilize in November, then rally up through December.
All right, well, no crash around the corner. But that's the nature of crashes.
Usually the advanced decline line tops out months before the market does, and the advanced decline line just hit a new high.
The internals are looking good in the market still.
The internals are okay. I just think we're a bit overdone here and have to pull back. And sentiment has been the key factor. It has held the market up against my expectations through August and September, but now it's started to turn positive, and look what happened today. So.
Yep. Look for good dividend stocks that pay nice dividends. Check out the Forbes Dividend Stock Daily, of course.